Gold has always shaped the empires. It has funded wars, built fortunes, and crowned dynasties. And right now, gold is shaping strategy. Titan Tata's crown in the jewelry space has just purchased 67% Damas of Dubai for $283 million. On paper, this is a deal. In practice, this is about outsmarting Tariffs, diversifying risks, and quietly positioning an Indian company on a global luxury map. Damas comes with 146 stores across the 6 countries of the Gulf, or the GCC: Saudi Arabia, UAE, Qatar, Kuwait, Bahrain, and Oman. Collectively, these 6 countries represent one of the fastest growing jewelry markets in the world. By 2025, it estimates that the market will be worth $3.6 billion. Between now and 2030, it is expected to grow at almost 17% every year. Gold alone accounts for over half of all the jewelry sold in those countries. Why? Because gold is not just fashion in the Gulf. It is savings, security, culture. Gold plays a role in weddings, dowries, and investments. Titan has just bought themselves a sensational seat at the golden table. Here is where things get way more interesting. Think of tariffs. In the United States, jewelry imported from India faces a crushing 50% duty. However, export that same piece through the UAE and the tariff percentage drops to just 10%. That's a 40% advantage, worth millions and millions of dollars. And each and every year for Titan, there is more to this activity than just a foreign acquisition. It's a tariff arbitrage opportunity. As Titan's managing director C.K. Venkatraman said himself, moving production to the Gulf makes total sense. Lower costs, lower tariffs, and a wider audience. And the numbers are already looking good. In the first quarter of this financial year, Titan's jewelry division grew year on year by 19%, reaching a total of 12,797 crore rupees in sales. Its big brands, Tanishq, Mia, and Zoya together accounted for more than 11,000 crore. CaratLane, Titan's digital first brand, grew 39% to more than 1,000 crore. And here's the big leap. International sales in the Gulf and North America increased 49% to 554 crore rupees. For the first time, that overseas operation made a profit. The overall net profit over 52% higher at 1,091 crore. Margins now are at 11.7%. compared to 9.7 a year ago. That is a healthy business operating in the right direction. But Titan isn't just done. It has plans to open 75 more stores across GCC. Yes, that's almost 700 jobs. CaratLane is expanding as well with 2 US retail stores. One in New Jersey and Dubai will have even more Titan presence. This isn't expansion, this is consolidation. Titan is creating a global footprint from workshops in small town in India to luxury malls in Dubai, now to mainstays in the United States. So what does all this mean? 3 things. First, Titan has found a way to convert the trade war into an opportunity. While countries impose tariffs on each other, companies like Titan are using geography as an opportunity. Second, it provides a reminder that retail isn't only about selling, it's also about supply chains. Manufacture in India, scale in Gulf, sell in the US. The model has changed. And third, it demonstrates confidence. Investors are already rewarded Titan for its boldness. Profits are rolling in, margins are expanding, and the global expansion is paying off. But here's the downside. Tariff loopholes won't stay open forever. What if the US decides to close the loophole? What if another wave of protectionism re-withdraws the rules? Titan has outplayed the system, but geopolitics can change overnight. The bigger question is this the future of Indian business? Outthinking tariffs, using acquisitions to avoid trade barriers, and playing the global game on its own terms? Or is Titan just buying time until the next trade wall appears? Think about it. Like, share, comment, and subscribe. And stay tuned to OneStats for the news that matters.